Hi, I'm Jillian Grennan, and I'm an assistant professor here at Fuqua, and I teach in the corporate finance program. I teach the daytime MBA and the exec MBA this year, and I'm thrilled to be a part of this Fuqua series on LinkedIn. I'm hopeful that the research I share with you today can help the viewers out there make sense of what's going on in the world. So if you like what you've been learning, please follow the LinkedIn Live series and Fuqua in general. So as way of background, I spend much of my time thinking about corporations and how they're creating value and thinking about today's business environment. And there are several big trends sort of impacting workers and firms that are likely to have big implications for value. One of those trends is what I'm going to talk about today. I'm going to talk about the implication of the seemingly unrelentless rise in institutional investors as owners of publicly traded firms. Collectively, I'll be referring to them as universal investors, but sometimes people call them the Big Three or the Big 12. So how did it all start? There's no question that today, most of the stock market is owned by a few large investment firms. For example, 70% of shares on average in any given public company are owned by institutional investors. The remainder of the shares, they're owned by, say, founders or some of the retail investors. Retail investors would be who we've heard about recently in Robinhood, but also Schwab, E-Trade, accounts like that. But essentially the biggest private funds, that's BlackRock, Vanguard, and State Street, they own 20% on average of any given firm. Imagine just three people owning 20% of a firm. But then imagine this, three people owning 20% of a firm for all the firms in an industry. That's what's happened. And this is why the Big Three are considered such an important phenomenon that we really don't know a lot about. So to give you a little bit more background, I also want to tell you that this was not always the case. This has actually never been the case before in history. It was actually the reverse. Those retail investors were the ones who used to own the majority of the stock. Okay, but as 401ks basically grew and grew, that's how we've got more institutional investors. So what happened was, at first, nobody really thought there was any problem with these people being, the underlying owners of the stocks. In fact, it was seen as a good thing. The idea was that, well, typically a mom and pop or somebody like me, I can't influence, the leaders of Amazon or major executives. But someone like Larry Fink, who runs BlackRock, he could be influential. And so the idea was that, by having these institutional investors, they could solve the bad apples problem for the few firms that might not be managed the most efficiently. Well, so a lot of people just always thought that these investors had, everybody's long-term interest in mind. But at the same time, there's been sort of another set of facts that have been coming out that have led everybody to sort of reconsider this. And what are those facts? Well, they're facts about wages and prices and sort of what's really going on in the economy. And so, for example, markups. So what were markups? They're the difference between the cost to produce a good and the price which customers end up paying. They're at the highest level that they've been at in decades. Okay, that means as customers, we're paying more. We should be paying less. Okay. On the other hand, we also know that, okay, that means that these firms are really profitable. They're bringing in all these profits because markups are so high. But they're not going towards wages. In fact, they're all tend to be going towards shareholders. So while there's a variety of explanations for these markups, and it could be globalization, technological change, commodity boom bust cycles, a bunch of different things out there, one of the other factors that people have started to say is, well, maybe these universal investors, these BlackRocks, these Fidelities could be part of the trend. In fact, so many people have thought about it, it's got its own name, and that's called the common ownership hypothesis. Okay? It's a number of legal scholars and economists and finance professors who are increasingly concerned about common ownership. What they think might be happening is that there's these gigantic institutional investors. They're gobbling up greater and greater stakes in companies within the same industry. Well, they fear that under common ownership, these public firms are going to no longer compete aggressively. They're going to no longer deliver you higher quality goods at lower prices. In fact, what they're going to do is maybe act like a cartel or a monopoly, or act in some way that they can charge these higher prices. So the idea is that maybe, in fact, they're anti-competitive. So you may be wondering at this point in time, well, why am I only just hearing about this now? There's been an increase in 401ks for years. Well, for a long time, people just assumed all firms maximize profits. And if they weren't maximizing profits, their investors would pull cash from the companies and go elsewhere. And so those firms would go out of business. But then came the idea of universal investors. If they own all the firms in the industry, they don't want a single firm to maximize its profit. Instead, they want the industry to collectively maximize profits. If you recall back to your Economics 101 class, how does an industry collectively maximize profits? Well, by acting as a monopoly or an oligopoly. And so, in fact, this universal investors, they're starting to potentially in this manner. So this ideal of competition then disappears. And this is how consumers end up getting stuck paying higher prices. Well, over the last several years, then, a number of researchers have started to look at this. They've started to look in detail at industries, look at pricing data, look at all this stuff and say what's happening. And so far, we're having some studies coming out. The evidence can be mixed, but one of the more prominent studies that came out was in the airline industry, and it showed that there was already consumers paying higher prices because of institutional owners owning basically all the airlines. There's also been work looking in the pharma industry and the financial services industry, all suggesting that, in fact, yes, these common universal owners are leading to anti-competitive effects. On the other hand, I will note that there's some industries where people have sort of been saying, the evidence really isn't out there. And so this has led a lot of people to try and figure out, well, is this story true or not? Maybe we don't have it totally right. And this is where sort of my research is coming in. A common critique actually in this literature has been that, common ownership measures only account for public firms. And the presence of private firms that compete with them, so think big entrepreneurial startups, might actually mean competition is still alive and well. So in joint research with Ofer Elder, who's an associate professor at Duke Law School, we started to examine some of these bases for the arguments about private firms. Overall, our research suggests that these arguments are really more nuanced. On the one hand, when we look at the big sort of unicorn startups, so think, those that have at least $1 billion in valuation, they haven't went public yet, but they're sort of like the prime target to go public. So this was Airbnb right before it went public. Okay. Well, we find that actually, if you were to incorporate these into aggregate measures of common ownership, it might actually make the problem worse. Why is that? You would think that that's totally not what I just said. Well, it's because, these unicorns too are increasingly owned by the same investors. In fact, when one thinks about the venture capital industry in general, one realizes just how far-reaching this common ownership hypothesis is. Venture capital-backed startups are an extremely important part of the economy, but an overwhelming share of the money in that asset class is controlled by a few hundred venture capitalists. So understanding if, say, SoftBank or Sequoia Capital is doing exactly what BlackRock and other big institutional investors are doing is sort of an important and fascinating aspect of it. Are they holding back competition? Are they stifling innovation? Well, our research suggests in one aspect, they're not. They're actually helping to make it thrive. The second key finding from our research that relates to this critique is that there might be a silver lining. This is the point that I really want to emphasize today, especially when it comes to founding new high-growth startups. So we take a dynamic perspective, and that is we say, well, maybe today prices are higher than we'd like them to be, but maybe the fact that we have this common ownership creating high prices is going to lead to a pricing war, and we're going to see entry. We're going to see these competitive startups come in and just totally revamp the space. And in fact, this is what we, if you can think of in your head, you can certainly start to think of examples there. In the airline industry, the one where all of the evidence was suggesting common ownership is increasing prices. Well, you can think about Spirit Airlines or some of these other low-cost carriers that have come in. They're trying to innovate in the space. But it's not really limited to airlines. You could think of it as simple things like Casper. Again, another firm that recently went public, who they just put a mattress in a box. But suddenly then the behemoths, those big industry players, had to compete and lower costs for mattresses. Or you could even think of the sort of classic retail traders, those in Robinhood. Robinhood, when it first came out as an app, they were the ones who introduced no fee trades. Well, then all of a sudden, Schwab and E-Trade and everybody else followed suit. And so there was these pricing wars. It's sort of the classic competition with a monopolist. Well, we wanted to study this in more detail because we believe that the significance of this could potentially, in this dynamic perspective, make everything, much rosier for this threat of common ownership. Well, when we studied startups, given that there's also just a decrease in the number of startups, we started to realize that the answer critically depended on the two facts we found. The first fact we found was that the importance of common ownership amongst startups actually increases aggregate common ownership. And to put that in perspective, let me just tell you that the VCs, we have calculated common ownership measures between them. They increased from less than 10% around 1995 to more than 50% by 2018. So these startups are also heavily commonly held. Okay. And so that would suggest that common ownership is now the norm even amongst startups. And what's more true is that in the space for startups, VC investors are often protected from litigation risk. That is, if they invest in the startups, they actually will often put clauses that other firms that they may be directly competing with on a business opportunity, that they can't sue the investors for taking that business opportunity. So there's a lot of interesting facts going on in the VC space. But one other fact about VC investors is that they tend to be much more active than institutional investors. They really take a hands-on approach. They're trying to help those entrepreneurs shape the ideas and basically grow the company. And so in that sense, they're there to facilitate information flows, and they could potentially improve coordination to make it more monopoly-like, or they could actually help firms pivot or do other positive things that might help ultimately make them the firm that can compete with those big, high-cost public firms that are commonly held. And so that's where we're sort of looking to test the hypothesis with the data. Okay, so what we do is we merge public firm common ownership data with this VC firm common ownership data, and we do it for a wide variety of industries, and we do it for over a 2-decade period. So we have almost 45 industries that we're looking at over 2 decades. So this is not just a single industry study. And what we observe is that the conditional correlation suggests that this entry channel of new startups coming in is really meaningful. We observe that greater public firm common ownership is associated with greater VC investment in early stage startups, especially in the common ownership of startups in the same industry as well. So to put these estimates in perspective, Series A financing, so that's sort of the first important round of financing, we see that it more than doubles on average when you're in a high public firm common ownership industry. So it goes from 8 startups in a year getting it to almost 21 startups in a year getting Series A financing. This suggests that the entry of startups, typically commonly owned by VCs, could counteract some of these anti-competitive effects and sort of some of these negative stories we heard in the beginning. Okay. So overall, we think that the recent work has highlighted the need to extend the study of common ownership beyond the sphere of public firms. And so what we're bringing to the table is to look at startups and to look at the VC industry. And we show that given the unique attributes of the VC common ownership, it may actually increase aggregate measures of common ownership, which would make you worry even more about us becoming less competitive. But at the same time, we also see this silver lining. We see there's a bright side from VCs pursuing an investment strategy that backs these firms that can grow and disrupt the dormant industries where large firms have limited incentives to compete. Okay, so this suggests that entrepreneurial activity may be a possible way to address the anti-competitive effects of common ownership of public firms. Okay, so we really want to see this disruption, this invention of new products, this better catering to consumer demand. So with that, that's all I have prepared today. So thank you. I am happy to take some questions now. Um, be feel have, Feel free to put them in the chat. Okay, so I have one question. So what do you see as important going forward in terms of BlackRock and Fidelity? Should we be regulating them? Um, so about regulation, let me think about that for a second. So there is some proposals out there. I think, for example, investors have, they're controlling lots of firms within an industry. So some of the ideas that I've heard put out there were that we should limit what BlackRock can own. Maybe BlackRock can only own one firm in an industry, or instead of them collectively all owning 5 to 10%, they're not allowed to own, more than 1 or 2%. Unfortunately, these types of proposals also often come with other side effects. And so I think there needs to be, at the end of the day, we really need a policy, but we need to understand exactly where potential harm comes from common ownership, and build a policy for these funds that really can protect consumers if that's what needs to be done, or to just allow the process to work the way it's naturally supposed to work. So I don't know if people saw this, but John Coates is going to become part of the Biden administration at the SEC. He's a professor at Harvard Law School, and he's put together some really, really interesting proposals in this space about what could be done about common ownership. So, he's going beyond this idea of check the box criteria and looking to answer other points. So other things I want to talk about, so sort of the next steps that we're taking with this research, I think this is one of the cool areas. So what we're trying to say is that there's entry, that, what's going on is that despite there being, high concentration of common ownership, there is now entry of disruptive startups. And so one industry that didn't happen to see price effects was the breakfast cereal industry. Actually, it was a recent Planet Money. I encourage you to listen to it. It's a really cool one where, they're just talking about it, and sort of it's a classic one that's been studied for many years. And they use sort of this switch from, there's a lot of private equity investing in the breakfast cereal space. And so you can compare when firms go from public to private. Now, mind you, we were just saying a lot of private firms are VC controlled, but this is thinking that maybe it's a little bit different, and these ones really are independent. And what they end up finding in their study is no price effects. But where our study is coming in is saying the other side. It's saying that, while maybe cereal, we didn't see price effects, we've seen a ton of entry in the breakfast food space. So we've seen a lot of healthier options of things to eat, or we've seen fancy donuts. I like the fancy donuts. I think they're yummy. Or we've seen different stuff come out. And so what we want to do is then go and look at this, what consumers are actually buying. And so there's data out there, scanner data, that you can look at and learn what consumers are buying. And we want to see if we're getting more product variety out there. I think product variety actually might in fact be one of the big benefits from common ownership, and that, certain firms sort of stuck to their same products. And this is where then you're starting to see all of these more sustainable or healthy or different varieties come out, largely because they saw like this markup in this space, and saying like, if you can do it with that much markup, we can do it, and do it in a better way. Okay, sorry, I have another question. So Larry wants to know how to learn more about this. For example, links to the papers, stuff like that. So there's been a lot of research and flurry sort of really fast in this space. I think this was because of the idea I was saying at the beginning, where essentially everybody just thought having your money with a 401k was a good idea because they could solve the collective action problem. That is, they were, these smarter investors, they were sophisticated, they could get management to do the right thing, they were going to solve the bad apples problem. And so it was not really until 5 years ago, when this airline paper first came out, Martin Schmalz is one of the key authors, but Jose Azar and several others have put together, some nice work on this where they've looked at it. I think some of the other interesting aspects of it, and at least from what people have been talking about, is the should we be going ex post or ex ante? And what does that mean? Well, in Europe, think about data privacy and what you have there. In Europe, they often will set up rules. Why is this? The ECB has always been a rule-making body, and they set up all of these rules ahead of time to try and get the best outcome. Whereas the US is actually quite the opposite. We've always been a very litigious country, and so it's let everybody do what they want to do first. Let's not put the red tape there, but then ex ante, let's go litigate and let's go put antitrust suits out there and break up the monopolies if there are in fact monopolies. And so this is sort of what we're seeing now with the cases against Facebook and Google. And so I think that's another important question that researchers are starting to tackle, which is to look and say, okay, should we be going after it from a head off the solution or wait till we see it to be a problem? And I think one of the cool things about waiting to see it is then that already spurs this entry of entrepreneurs. And so I'd love to see some of the solutions going forward, especially also as a business school professor who hears these lovely stories from students about firms that they want to start or their awesome ideas for new things, doing stuff to help them start good companies and to generate that competition out there. I'm a firm believer that competition is good. It's going to lead to better products. It's going to lead to this lower prices and higher quality, that people are coming up with great ideas every day. It's about how do we get these ideas funded? How do we get these ideas out there? How do we ultimately commercialize them? And so I would love to see more effort to help these students and help others out there in need who are trying to put forward sort of these new, more inventive ideas. Other thoughts that I have about Fidelity and BlackRock and sort of this whole governance space. So I do think that that is something that is not really talked about. So Larry Fink, in some ways, he's always putting out these letters, and he puts out his annual letter, and this year he was talking about climate change in his letter. And then you hear others saying they're not impressed by what he's doing on climate change. I mean, I feel like while the big three get this sort of disproportionate attention, they do own, trillions and trillions of dollars of the economy, and so they need this attention. And sometimes there is a view in the literature that these guys are, they're just pretending that they're actually care deeply about governance. And so the fact that we ultimately see that these companies aren't really doing what's first best makes us wonder if perhaps what the strategy they're using is just this strategy of omission. They're not actively influencing anybody. They're just, failing to argue that CEOs are getting paid too much. Or something like that. I think we just saw there was a story about one of the banking executives overtook Jamie Dimon as the highest paid banking executive, I think he was making more than like 35 million this year or something like that. And how, why? I'm sure BlackRock owns a lot in this company. State Street owns a lot in this company. Why are they not pushing back harder? Okay. I think that's type of stuff. I have another question. We hear that BlackRock and other asset managers are getting more active in the ESG space. Do you see collective ownership maybe helping drive better behaviors from firms because of that? I think the ESG space is a really interesting space, and the active managers, because of this sort of tension and philosophy in the ESG space. So you have the quant funds who traditionally they're all about the sort of factor investing. Let's own a little bit of everybody, but we're going to allocate based on these reasons. And sort of what ESG has brought back is this idea that, maybe we should really be focusing on fundamentals and selecting a few firms that are based on fundamentals. And really what ESG brings in the literature is this sort of divergence of ideas. Not everybody knows what is good social or good environmental or good governance. And so there's a lot of disagreement about the data and how to rate firms. And so this is where fundamental analysis comes in. It sort of reads between the lines and suggests, this is the right strategy to go forward with. So back to your question about sort of BlackRock and those working in the ESG space, I mean, they're certainly going to want to go into that space to attract new assets under management. Do I think that their type of ownership is going to help or hurt ESG? I think I've seen one paper sort of starting to look at this. You would think, though, that just as I had been saying before, one of their strategies might be the strategy of omission. And so this was where the CEO pay might be really high. Why? Because they're not going to, want to, make the CEO aggressively compete, or maybe something like that. You could see the same thing where maybe Larry could do a lot more on climate change, and he's basically doing the bare minimum to keep the regulators off of his back, while at the same time, a much more aggressive approach could actually solve these problems a lot faster. And so this is what's been bringing into question some of these stewardship models. And there's other models of what we really should think of institutional investors doing and being responsible for. And I am really excited about this space. I think assets are certainly flowing into the space, and so seeing if it can be successful, and hopefully if it can be broadly successful, more than just the fundamental analysis, but actually using alternative data and stuff like that to help with quant strategies also being broadly successful would be really exciting. But overall, I think that those are, some of the key features. I just want to hit home sort of my points from today, which were, this common ownership phenomenon is important. It's important to study. It's important to understand as an investor if you should be putting your money in your 401ks. Your money's safe in your 401ks. They're getting you excellent returns. You don't have any doubt about that. What's a little bit concerning is that maybe it's not translating into the products you get to buy out there, and maybe we'll start to see prices rising more than we would otherwise want them to. And so this is where the role of startups can come in. And what our paper is showing is that it looks like, we don't have causal evidence right now. We have correlations, but it looks like there's entry. And so in the next step, we're going to go forward more with this research and try and use scanner data to understand exactly the product variety out there and if consumers are benefiting from the product variety. And I'm excited to see what evolves. I'm also happy to share more research on LinkedIn with those that are interested. But also next week, we have more exciting stuff coming from the professors at Fuqua. Professor Daniel Vermeer will discuss new research that suggests the growing ocean economy presents a variety of risks and opportunities towards sustainable and equitable use of the ocean. I'm excited to learn about that more. And thank you guys.